Hey, welcome everybody to the 40 Finance channel. Here on a random Sunday live stream, it's halftime of the football game, and thought I'd stop by because I've been reading a lot this weekend. Reading a lot and looking over the different discussion boards, whether it's Reddit, Twitter, all the places where people chime in. And to me, it's really starting to feel super bearish out of the public. Like I'm hearing recession words, okay? Recession words, which obviously indicates that the GDP or the economy in general is not going to produce any more than they did the year before, and potentially less. So some of these things, in my opinion, are very far-sighted arguments, okay? And by far-sighted, I just mean they stand all the way over on one side, and I think there's counter-arguments to all of them. And why I want to get on today and talk a little bit about investing mentality during these things. The bottom line is, for most folks, at least right now, inflation is a ding and interest rates are a ding, but we're nowhere near any type of historical levels. Okay, there's no talk of historical levels being broken right now. Now, we had arguably a historically high valuation in the stock market, but when I think of like really big danger signs for the US economy, talking about recessions and stuff like that, I think about periods with high unemployment. Obviously, right now, we have very low unemployment. Not to mention, there's the argument on unemployment right now that perhaps the government stimulus was holding back some of the workforce from actually working. We'll see if that shakes out, because it does appear that some of those things have ended. So anyway, I think about high unemployment. I think about bankruptcies from a company perspective, corporate perspective. I think about slowing sales and slowing growth for companies, right? And I also think of periods, quite honestly, with baseline innovation. Not exponential innovation. I think if you go back to the 70s through the early 80s, that was a period of time, off the top of my head, that the world just kind of chugged along, okay? We didn't have huge technological advances during that time, and we were sort of in just this stationary bike, if you will, with advancements. So this is all my opinion, but I don't think that unemployment is a concern right now. I don't think that corporate bankruptcy is a concern right now. And I'll go on the record to say that I think from an innovation standpoint, this might be the most innovative time period I've ever lived in my life. Now, stock market-wise, that doesn't take away from the fact that valuations got stretched beyond belief, and I think we've all seen it. I talk about it a lot on this channel. But I guess the reason I was prompted to come on today is just to kind of level set at least my thoughts. How bad is what we're seeing right now? How bad could it get? And what does it mean for you? And I'm going to take not necessarily a bullish view, but I'm going to take a less bearish view than words like recession. Okay, so let's just talk it out together. And you can the whole point of this video is just for you to think about things. All right, so I wrote a couple things down while I was thinking about this video, and we're talking about which investors will win in times of high inflation, high interest rates, if we get there, right? I think, honestly, high interest rates is not even a thing, okay? Because we're at zero. And if the worst case scenario was 2%, you can look up on the charts in history and figure out where 2% lands. It's going to be ultra low compared to historical standards. So don't sweat interest rates too much. Now, when those things happen, which investors win? So here's a few thoughts in my mind. I wrote down, companies, or excuse me, people who invest in strong companies that have earnings, a track record, and of course, some version of a moat around them. It doesn't have to be the strongest moat of all time, but you definitely want to have some pricing power. So that would be, there's tons of people who only invest in top 100, 200 companies. So, if you're thinking about obviously the FANG stocks, but then think about others. There's Nike, just to pick off one off the top of my head, potentially like a Starbucks, things like that. Companies that have really ingrained their brand and historically have been profitable and carry manageable debt loads. So the investor who's in those, AKA blue chips, I think that person will see limited downside in this environment. Doesn't mean you won't have downside, but if you know the company that you're investing in, if you use their products and you see them everywhere, I think you'll have limited downside in this particular environment. The next investor who I think will win that I wrote down was DCA investors, dollar cost average investors, the people that you read about all the time who buy a little bit every day or every month or whatever their schedule is, regardless of where the market goes. All right, regardless of where the market goes. And the reason that they win is because their price average is better than everybody else. Their cost basis tends to be better than anyone else. We've all heard ad nauseum about timing the market, how impossible it is, and yet here we are today, particularly on the message boards and social media, people are talking about what? They're talking about timing the market, talking about selling and getting out of the market. So those are people that are playing a different game than the majority of folks who just have a retirement account or a dollar cost average. That's another game than what those DCA investors are playing. And therefore, I think the DCA investor life doesn't change probably at all. In fact, you don't want to miss this opportunity if you're DCA because you want to pick up on the low prices. All right, next I wrote dividend investors. There's a lot of dividend investors, and I guess why they would likely win. I'm not particularly enthralled with dividends. There's nothing wrong with dividend investing. It's just not something I like to do myself, particularly in a taxable account. But the dividend investor is relatively safe, certainly over the short term, because the dividend rates, they get voted on typically each quarter, and certainly if we had inflation go through the roof tomorrow, then that dividend is coming no matter what. And there's plenty of great dividend video channels on YouTube that go through, people, companies that have been raising dividends for 50 years straight, aristocrats and all this other stuff. So I would say those folks, dividend investors, probably not too worried about this current environment. All right, the fourth one, I'm just going to say this because I think it's true. Rich people, okay? Rich people are not super concerned about this market, assuming that their wealth includes a cash aspect to it, right? Now, a leveraged rich person is probably a little upset, but then again, how rich are they? I don't know if I would say a leveraged person is actually wealthy, But those that own assets and have a cash balance in order to take advantage of these opportunities, I think that those investors will do fine because they can they're not under pressure, they have plenty of cash, and they can dip in whenever they feel like it and conceivably wait till they see a bottom. So that's, my 2 cents on that. And then the last one, which is a little broader, I think there's an aspect to the realistic investor that makes a lot of sense now in this time. So realistic is, of course, someone who understands the environment and likely isn't looking for 100x gains and talking multi-baggers and everything else. In this particular scenario, I would say a realistic investor understands what is happening, what could happen, and knows that perhaps the long-term path, everything will sort itself out. And that's, whether or not I'm realistic, I will tell you that I'm long-term. And it's funny how that has faded away over time. In as far as people claiming to be long-term investors, it's interesting how that has changed over time. Some people, I think, when they say they're long-term, they mean a year, but that's not really historically accurate. A long-term investor would be, in my personal opinion, a minimum of 3 to 5 years that they're looking to get the money back on their investment. Now, if they made an investment, so I think about maybe Tesla shareholders, for example, if they made an investment and they held it for a long time and now the market's looking a little shaky and so they sell out to just lock in their gains, I think that's a different story. Particularly if you got in super low on a company like Tesla. But generally speaking, for the stocks, let's say that you have purchased between July, August, and now, the long-term outlook, depending on how you bought those and what your sentiment was when you bought those, the long-term isn't January. 6 months later, that doesn't count. So I think long-term investors will do well in this environment. I want to say shout out to Lion, good to see you. Couple names I don't recognize. Redeem, good to see you. Level 2 trading. He trades futures, which I'd rather do than own stocks, which is perfectly fair. There's 100 ways to do it. Now I want to talk for a second about the losers, and then I can get into questions and all that. The losers in this environment, and we're probably already seeing them lose out, is of course margin traders. Margin traders are going to be in a tough spot, and some of the short-term volatility that we could see January through February is going to be influenced by those that borrowed money to buy shares. And that's unfortunate. There's a lot of risks with margin, and some people are going to learn the hard way. It's just the way it goes. Next, I would say, I talked about rich folks having an advantage in this time, and so I'll say subsequently, cash poor people will be at an unbelievable disadvantage. Unbelievable disadvantage because if they're 100% invested, things are only going down, and they don't have the cash to either DCA, or buy the dip in general, right? And the only way they could conceivably win is to sell a losing asset to buy what potentially could be another losing asset over the short term. So unfortunately, cash poor people are facing a difficult time. Next, investors that would probably lose in this situation, story stocks that we saw a lot last year. Of course, those are going to be high risk. Some of the stories will play out. Most story stocks, in my opinion, are based on a long-term story, but it doesn't seem like the folks that buy them are always in for as long as it's going to take to win on them. So just know that a story has to have fundamentals, and it can't just be a headline, because everyone can make a company that says we're going to do X, Y, Z, and raise money. And we've already seen it with companies that falsely raise money and ultimately turned out to be nothing, right? Shams. And so you got to be careful of story stocks. I think that goes back to the quality portion of investors that win. Track record is huge, man. Track record is huge. If you go into a stock like P&G, I don't own P&G and or consumer packaged goods. I'm not super interested in that. But I'll say one thing. You go into P&G, you can see a hell of a lot of history. That stock's been trading for a long time. And it's up and to the right, like you want the graph to be over 75, 100 years or however long they've been doing it. That is reassuring to some degree when you can see that a company has a track record. And lastly, I would say a potential loser in this environment is going to be momentum traders, not focused at all on fundamentals, very similar to story stocks, but they're trying to ride the wave up. Obviously, momentum up is going to be potentially hard to find in large swaths here in the first couple months of the year. It doesn't appear like we're going to have a huge run up through February. I would be surprised. So momentum could be tough, and then shorting momentum obviously can be very tough. And you're playing against the odds with shorting momentum because I believe historically stocks go up something like 70% of the time on a daily basis. So you'll have to look up that stat. But if you are not experienced in shorting stocks, which would be myself, just know that you're playing against the house big time by shorting. So make sure you know what you're doing before you get into that game. All right. So a little bit of a ramble there to start off, but that's how, this inflation, interest rates, all this talk that I see, this chatter going on, holy cow. I think you have to look at both sides of the coin, and I think you have to think for yourself, and I think you should read different views, which is why I'm coming on here and taking a slightly different view, perhaps, than what you're seeing in other places. I also have a couple resources that I wanted to share in regards to inflation and the stock market, things that I've been reading. I'll kick off with this one. Unfortunately, this was from April 2011, but sometimes that's good because it looks back in a different place. And this person, Jim O'Shaughnessy, did a study, and he broke out inflation into three kind of pillars. Severe inflation, in which annual inflation exceeds 10%. So the annual exceeds 10%. That's going to be important to consider when you go through this. High inflation, years in which annual inflation was greater than the average, blah, blah, blah. Higher than 4.4%. All right. I think for us this year, pending the Fed moves, we might be in a high inflation. I do not personally foresee a severe inflation, but we'll see. Again, you have to exceed 10% across everything, basically. You might get a category or two that go above 10%, but they're talking about everything's up 10%. Moderate inflation. Let's see, where does he land on moderate inflation? I don't know if he actually gives between the high end of the Fed target 2% and 4%. So he says basically above 2%, I guess, is moderate inflation. Low inflation is 0 to 1.6, and then there's deflation. Okay, so in regards to that, he looks at between 1900 and 2010, how many times do we have each of these things? Severe inflation, which is the one we're probably most concerned about, that's going to get into death and destruction kind of thought process. That was a 7% of the time. Okay, high was 19, moderate 41. So, high plus moderate 60% of the time right off the bat, and everything else is an outlier. All right, so then he does these little graphs, and I'll go through them quickly. Severe inflation, here are the years that we had severe inflation according to this report. The average annual inflation during that period was 15%. Bond return was minus 12%. Real stock return, including dividends and everything, minus 7%. So think about what you're reading on the internet right now with the death and destruction folks. We're not in 15%, okay? And let's just pretend we get there. That, I think a lot, if you told people we were going to get to 15%, I think a lot of them would project that the stock market would drop 50%. I really think people would think that. And the fact of the matter is, according to this graph, it's minus 7%. Okay. That's not positive, but it's not negative. And if you're a long-term investor and you assume that this might only go on for a year or two, I would say buy the dip, right? I would say DCA across this time, because 5 years from now, who knows where we'll be, and you could really be picking off P&G shares and Google and Walmart and whoever else you like, could be picking those off for a pretty good deal and pat yourself on the back in 5 years. All right, let's go to high inflation. All right, so this is where I would say we land, will land. This is just my opinion. Average annual inflation during these time periods listed up here, 6.4%. Okay, I think a lot of people are talking about 7. I would say a lot of unqualified people, including myself, are talking about 7%. Average real bond return, minus 2.8%. Who would have guessed that, right? Who would have guessed that? And the average real stock return, oh, look, it's positive, 2.5%. Okay? High inflation, stock returns 2.5%. That's a lot different, guys, than the stock market's on fire and we're all going to die, right? Let's just keep that in mind. And then Fed target to moderate, so you're 2.8%. Obviously this is a good world. I don't think anybody would be super concerned about it, and stocks are running about 10% there. All right, what else? What other tricks do I have up my sleeve? I did this one. What was this? I just marked all these tabs and then I went live. Fed's fund rate versus the S&P 500. So switching gears and thinking about interest rates for a second. And we're going back to 1980. You can see the S&P 500 has obviously done what it's done. But let's pay particular attention to times of increasing interest rates. All right. And here we go up. I'm try to get to not mouse over that because it's hard to see. So I'm going to go below here. Looks like, off the top of my head, 1993 or 94 or so, you started to have an upward trajectory in interest rates, right? Well, stocks were arguably flat, and then they started going up again. So that would kind of blow up the interest rate scenario on that particular chart. Then if we go to 2000, we had rates that were low here because of some weakness in the economy. And we went from here all the way up to here. And at least through my eyes, the S&P 500 also went up during that time, okay? Then you had 2015. Looks like we'll actually start Fed funds rate. I'm trying to do this mouse over. I apologize if it's not looking good. But 0.09% got up to 2.4. What did the stock market do in that stretch? Or the S&P 500? Oh, geez, it went up. All right. Think about where you're hearing your information from. Think about the true bear case. Don't blame things on interest rates. Don't blame things solely on inflation. There's a lot more to it, and I guess that's my takeaway. And I just wanted to come out today, and I'm gonna say hi to you guys here in a second. But I just be careful with the extremism. And you can argue that this is an extreme video because I'm saying the opposite of what everyone else is. And frankly, I'm just a guy on YouTube, right? So, but there's a lot of louder people than me. And I just wanted to give you guys a couple points in there, maybe just to be thinking of another way. The stocks, in my opinion, that are getting crushed, the minus 50s, the minus 60s, and all the stuff we've seen since Jan 1, I'd love to tell you I'm surprised they went down. I'm surprised they went down as far as they did, but nothing about their valuation surprises me. I own DraftKings, and I'm not selling it. DraftKings was $50, $60, I don't know when. It's like 20, and it's probably going underneath 20. And I don't really care right now at this second. I mean, I'm in at like $30. The game for DraftKings is not 2022. It's not 23. It's none of those things. It's so far freaking out that I wasn't expecting to sell and make a bunch of money, if it even works at all, right? So, Don't think that I don't have the pain too, because I have several stocks similar to DraftKings that have no earnings and arguably a price to sales, arguably a story. I have my share of those names, but the difference is for me right now, I'm numb to the negative. I really am, because I don't think that this goes on forever. And that's just my take. All right, let me get a drink here. Lion has switched over to Chiefs fairly quickly after the Cowboys lost. And yeah, the Bucks, Tampa Bay Bucks, let me check the score. Woo! It's now 27-3. Unbelievable. But I'm in Cincinnati, by the way, so I'm an Eagles fan at heart, but man, oh man, the Cincinnati Bengals, that was so much fun. We were out and about and at a place watching the game, eating pizza with friends, all the stuff, and it was just a lot of fun. Level 2 trading. Micros have been a godsend to me as I can hold. I don't understand that. The guys that have come into trading during the pandemic most likely getting hurt the hardest? Absolutely. Do you think money flow will go to China? That's an interesting question because of, I assume, level 2, that you're talking about the fact that China is fiddling with their interest rates the other way. So after that Evergrande crisis, they started to give businesses an optional line of credit, which, some would say that that's going to benefit Chinese businesses and perhaps in technology. The other thing with China stocks right now is they're beaten down, right? So, that we've talked a little bit about Alibaba on this channel, and I don't particularly, buy single Chinese stocks, but there's something there. I mean, there could be something there. And that whole world is controlled differently than our world here in America. So I guess level 2 trading, I would say yes. I would expect China to get some inflows. Marcelo, how you doing? Radim, I plan to DCA, TQQQ, UPRO, and a little bit of SOXL once the market cools down. Quarter of the count will be on leverage. Yeah, I mean, so you're talking to me, you're talking to the right guy, because I'm pretty much doing the same on TQQQ. And I've looked at SOXL. I think SOXL has a lot of opportunity, but I think that the problem right now is that like NVIDIA is still so high that I would be patient with that one. But just to be clear, I'm not in TQQ, all the Qs, to redeem my shares in February. It's a much longer haul than that, but similar to you, I am waiting. I do want to see things cool down. I've been buying a share here and there. I literally have 3 shares right now, so it's a nothing burger, and if it explodes tomorrow, I'm not going to cry. But I'm with you, Redeem. I think that if anything else, that trade or that investment is a contrarian play, and you say very clearly that a quarter of your account would be there, a 25% contrarian play on the best tech companies on the planet, I don't think is the worst idea. And there's plenty of others that would say it's too risky, though. But good luck. Level 2, you have to look at the book QE is more important than rate hikes. Yeah, I would agree with that. Stanley Song, how you doing? Level 2, yep, they doing QE while Fed tightening, so it will be most interesting study this year. Yep. China will be an interesting comparison, and you better believe that the USA will be watching, right? I think I'm not a political kind of person as far as whatever. I have my views, but I don't talk about politics on this channel. But I'm going to be, I mean, can you imagine the pressure on Biden right now? Like all the stuff that's going on. And then if China starts to spin things around and does QE and gives interest rates and starts to kick our butt economically, that's a lot of pressure. I would not want to be the president right now. I mean, I frankly, I would never want to be the president, but I sure as heck would not want to be doing it right now with all the stuff that's going on. Frankly, it's like an impossible job. All right, level 2, or Daniel, what's your take on Shopify and Etsy? I personally think they're both overvalued. Shopify much more so. I hope you're well. Haven't been on. Yeah, good to see you. Thanks for coming back. I agree with you in this particular environment, and let's look at them for fun. I think that you can wait. I'm keeping track of that football game in the back. Let me get back to Yahoo Finance here. All right. Squeeze this in. So I love Etsy, been in it before, sold out when it hit 300. One of the very few stocks that I got lucky on last year in terms of timing my exit. I would have been glad to hang on to Etsy for even longer, but it just got way out of capacity when it was getting close to 300. So next year right now stands at 350. 20% growth on the top line. So 350 and you're at 148. That puts your forward P. I was going to say 60. They're saying 59. I just am really worried about the compression from this environment, that it would go down more, especially at a 20% growth rate. So yes, I think Etsy is a great company. It's not the worst thing to buy at 148, but we have to really start looking at these forward PEs now and getting greedy, right? Greedy meaning expecting more. Because you have, this PEG ratio, one's good, right? And they're in 2.3. Some of these things shake out as soon as earnings, when they come out and give their guidance for 2022, all this stuff will change a little bit. But I agree, we would likely, in a consistent downturn, we'll likely see Etsy shave a little bit more off. I wouldn't say it's free or a no-brainer right now. As far as Shopify, I'm watching that one too. I would love to have a couple shares, but I misinterpreted. Let me see if this is right. Okay, well now you're down in the 882s after Friday, and I guess I missed that because I'll tell you, it's getting close. If you wanted to do a very simple 100 forward PE, which is probably absurd in this given environment, but it's much lower than where Shopify has traded, then you're at $860. All right, now this is a company projected to grow plus 32%. So their growth rate is at least on paper, significantly higher than, like your Googles or whatnot. I would say Shopify is getting close. I guess, how much their world has changed through all this, we won't find out till Valentine's Day. Interesting that Morningstar put an 862 fair value on it. And you can see how they've done this forward PE. Historically, if you got forward PE of 100, you're cranking on Shopify, right? They're in the 300s, 200s. I don't know. It's probably worth a bet. Certainly at 860 or below. And frankly, what's the difference between 860 and 882? I'm watching it. I likely will not buy it at this price tomorrow. It could even get to 874. But I think most of that is because you have to get greedy on these things. And the irony, though, for me, the super irony of saying that is I'm peppering in a QQQ and a couple shares here or there on TQQQ. And that is simply because I think that the individual stocks are getting harder to discern right now. So when we looked at Shopify, you went from the 200 some odd PE, and then I was arguing maybe you got a forward PE of 100. Obviously, that's going to be like one of the better deals we've seen out of them. I just don't know if it's enough, right? I just don't know if it's enough if people really start needling through things. So I find that the QQQ right now is just easier for me to manage. And I think, if we're talking about long term, I have zero concerns about the long-term future of QQQ. We might have a bad year, we might have a bad month, who knows? But that's an area that's going to lead for a while. All right. Stanley lost more money on playoff betting than Bitcoin investing. Holy cow. I'm guessing you had the Packers and the Titans. I thought, on the Titans game against the Bengals, I wasn't, sure that the Bengals were going to win or anything, but I knew that for the Bengals, I would have rather played them than like the Chiefs. Just me, because I know that, if you could put a dent in Derrick Henry, then Tannehill has to throw, and that's always been a catch-22. But sorry to hear that, Stanley. Level 2, Apple guidance is what I'm looking for most importantly, and I agree with that. I think it shifts the entire consumer conversation, right? Are people buying phones? Do they want phones? Is this an upgrade cycle? How have they responded to prices? I think Apple is just a key indicator of the consumer economy. And they have China. They have China in there, right? They sell a lot of stuff in China, a big portion, as a matter of fact. The other one, level 2, that I did a video recently, And obviously Microsoft, but that's more like corporate enterprise, just looking for slowing sales, hopefully not slowing earnings growth. And I put MasterCard in there on the video I did about upcoming week because MasterCard's volumes are going to impact Visa, PayPal. It'll give us a little read on travel as well. So should be interesting. All right. If Apple goes down, watch out. MasterCard for consumer. Yep, we're all on the same page. All right, guys. It's good to see everybody. I'm going to head out and watch the rest of this football game, eat some dinner. I hope you guys are doing well. Tomorrow's kind of lame market-wise. I mean, it's a Monday. There's some banks out there. I didn't particularly see anything huge just when I did a spot check. Tuesday goes Microsoft. Wednesday's the Fed, the second day of the Fed meeting. So typically Jerome Powell speaks about 2 o'clock, 2:30. And then Thursday, like we were just discussing, you got MasterCard in the morning. You got Apple in the afternoon. So we'll see how it goes. But thanks. Have a good day. And we'll see you on the next video.